While fear grips the market, institutions are buying Bitcoin like never before. The channel CryptoRover highlights that BlackRock just had its largest inflow in 5 months, aggressively fueling this recent pump and pushing through daily resistance levels. But is this just a trap? According to Ben Cowen, we're in a midterm year, which historically follows a brutal bear market pattern of lower highs and lower lows. He points out this March 2026 rally is exceptionally weak compared to past cycles, and warns a major low could still be coming between April and June. Adding to the chaos, Crypto Jebb notes that a massive geopolitical conflict surprisingly caused a $5,000 Bitcoin rally, driven by a huge short squeeze. He's buying cautiously, but believes the real bull market doesn't start until we break $80,000. Finally, DataDash cuts through the noise with one critical number, the $96,000 yearly pivot from 2025. He states that until Bitcoin reclaims this level, the macro trend remains firmly bearish. So with institutional giants accumulating while historical data signals danger, which force will win out? In the latest video from CryptoRover channel, we're told Bitcoin is pushing higher and breaking through some important resistance levels. A huge reason for this surge, even with global chaos, is major buying from big institutions. BlackRock, for instance, had its largest inflow in 5 months, showing they're accumulating heavily while others might be worried. Right now, Bitcoin is breaking out of a daily downtrend pattern but is still stuck in a larger sideways consolidation. The speaker is holding off on entering his next big $12 million trade, feeling it's a bit too risky at the moment. He's got his eye on the $54,000 to $57,000 range as a sweet spot to buy in. If the market rallies from here, he'll still benefit from his existing spot holdings. A key level to watch is around $72,200. If Bitcoin can break its current resistance, that's the next likely target. Ethereum is also just trading sideways in a big consolidation range it's been in for over a month. The main message is that this pump is fueled by serious money coming in through the US Bitcoin ETFs. So what's your next move? The videos focus on institutional accumulation as the primary driver for Bitcoin's recent strength, is well-placed, and reflects the current market reality. Data from early March 2026 confirms this, with US spot Bitcoin ETFs seeing a significant net inflow of $458 million on a single day, reversing a multi-week outflow trend. BlackRock's IBIT fund has been a clear leader, consistently pulling in hundreds of millions, which validates the video's specific mention of their activity. This institutional, buy-the-dip mentality is creating a fascinating divergence where large players are accumulating even as retail sentiment, measured by the Fear and Greed Index, remains in extreme fear. The speaker's cautious stance of waiting for a better entry point, possibly in the mid-$50 range, aligns with analyses that see the market as structurally fragile despite the inflows, with significant downside risk if ETF demand falters. While some analysts are calling for a rally to $100K or more in March, the market remains in a consolidation phase below key technical resistance. The developing regulatory landscape, particularly the implementation of the Genius Act for stablecoins and the potential passage of the Clarity Act, is a major factor to watch, as clearer rules could unlock further institutional investment throughout 2026. In the latest video from Ben Cowen channel, the discussion centers on having a bear market state of mind for Bitcoin, especially during a midterm year. Drawing parallels from 2014, 2018, and 2022, the analysis shows these years are typically marked by a series of lower highs and lower lows. Historically, Bitcoin tends to form a local top in the first week of March before heading down again. This year, however, the rally is notably weak and hasn't come close to the 21-week EMA, which sits around $85, a level reached in previous midterm year bounces. Instead of trying to catch every small upward move, the speaker suggests it's better to be patient and wait for the market to play out. The expectation is that Bitcoin will find its next significant bottom sometime between April and June. The video also points out that while Bitcoin is currently underperforming the average of prior midterm years, its general trajectory is still tracking the historical pattern. Ben Cowen's analysis of historical midterm year patterns provides a compelling framework for navigating the current market. His data-driven approach aligns with the cautious sentiment seen across the board in early March 2026. Recent market activity shows Bitcoin struggling with key resistance levels, with one report noting a decisive rejection at the $70,000 mark. This supports Cowen's observation of a weak March rally. Furthermore, the sustained correlation between Bitcoin and the S&P 500, which stands at 0.55, reinforces the idea that macroeconomic factors and broader market risk appetite are significant drivers. While some analysts see signs of whale accumulation and slowing ETF outflows as potential catalysts for a bounce, the overarching structure remains bearish for many. Regulatory developments, such as the OCC's proposed rules for stablecoins under the Genius Act, are also shaping the landscape, potentially bringing long-term stability but adding to short-term uncertainty. Cowen's advice to wait for a more definitive market structure to form, rather than chasing short-lived rallies, appears prudent given the mixed signals and persistent headwinds. In the latest video from Crypto Jebb channel, the discussion centers on the major conflict in the Middle East and its surprising effect on the crypto markets. It was widely expected that a war involving Iran would cause the stock market to plummet, dragging Bitcoin down with it. However, when the U.S. stock market opened, it held steady, and Bitcoin experienced a massive rally, jumping nearly $5,000 in a couple of hours. The theory presented is that the military strike against Iran's leadership was so effective that it quickly neutralized the threat to the Strait of Hormuz, a critical passageway for about 20% of global oil exports. Because the worst-case economic scenario didn't play out, the fear that had been priced into Bitcoin was rapidly unwound. This caused a big short squeeze, pushing prices up. While this is seen as a short-term bullish signal, the future remains uncertain. The speaker believes the situation will likely lead to months of chaos. He suggests that for a true bull market confirmation, Bitcoin would need to break above $80,000, and until then, he still sees a potential dip into the $50,000 range. Despite the short-term rally, he has been steadily acquiring Bitcoin in the $60,000, emphasizing that anything below $70,000 is a good price for the long run. The video presents a compelling, buy the rumor, sell the news theory, where Bitcoin rallied because the initial conflict wasn't the market catastrophe many feared. However, this analysis seems to have captured a very brief, perhaps premature, market reaction. Recent reports from sources like CBS News and Al Jazeera paint a different picture, with the Dow Jones plunging over 1,000 points as the conflict escalates. Furthermore, contrary to the idea that the threat was neutralized, Iran has reportedly closed the critical Strait of Hormuz, and maritime insurers are canceling war risk coverage, suggesting the economic danger is just beginning. 1416. This geopolitical turmoil introduces serious, short-term volatility that contradicts the video's bullish take. Zooming out, the broader crypto environment is benefiting from strong underlying tailwinds. Regulatory frameworks in the U.S. are solidifying with initiatives like the Genius Act, which brings much-needed clarity. 1719. Simultaneously, institutional interest continues to grow, with major players like BlackRock providing more avenues for large-scale investment. The current situation is a clash between severe macroeconomic headwinds and strengthening industry fundamentals. In the latest video from DataDash, Paul Sampson gives a high-level look at the most important levels for Bitcoin, tuning out the market noise. He's in the camp that expects lower prices but wants to identify where that outlook could change. The single most important level on his chart is the yearly pivot at $96,000, which is the average price from 2025. He treats this like a non-moving average, explaining that being below it is bearish, just as we are now. Historically, these yearly pivots have a 70% chance of being hit in the following year, and are often respected as major support or resistance. For a bullish shift, Bitcoin needs to first reclaim the $84,000 area, but the real game changer would be getting back above the $96,000 yearly pivot. Until that happens, the trend points downwards. He also points out a big, untapped pivot from 2023, way down around $35,000, which remains a significant magnet if the market continues to fall. He also briefly touches on traditional markets, noting the S&P, NASDAQ, and Dow all look top-heavy and due for a correction. Finally, he identifies a potential long-term bullish setup in MicroStrategy, which could see a 60 to 70% move if it confirms a bottom by closing above $141. The video's focus on high time frame yearly pivots offers a grounded, data-driven perspective that cuts through short-term noise. The emphasis on the $96,000 level as a bull/bear line is a clear and actionable thesis. This technical viewpoint is particularly interesting when contrasted with the current market's macro drivers. As of early March 2026, institutional influence is a dominant theme, with some analyses suggesting the historical 4-year cycle might be breaking due to the impact of spot ETFs. For example, reports indicate that institutional adoption is accelerating, with ETF inflows since 2024 significantly reshaping market structure. This influx of new capital could mean that historical price structures, like the untapped $35,000 pivot, may not be revisited as readily as in past cycles. The speaker's analysis of MicroStrategy also aligns with its current perception as a leveraged Bitcoin play. Recent news confirms MicroStrategy continues its aggressive accumulation, purchasing 3,015 Bitcoin in late February, underscoring its unwavering strategy even with its stock under pressure. Meanwhile, the speaker's caution on traditional markets is timely, as geopolitical tensions and inflation fears have indeed caused the S&P 500 and Nasdaq to pull back sharply at the start of the month.
So after breaking down 4 different perspectives, a clear picture emerges, but it's one of conflicting forces. Across the board, there's a consensus on caution. Whether looking at historical midterm year patterns or high timeframe technicals, the broader market structure is seen as weak and in a consolidation phase. The major disagreement is why we're seeing any strength at all. Is it a short-term geopolitical bounce or powerful, sustained institutional buying? This leaves the critical question: can this new institutional demand overcome a historically bearish setup? The key takeaway: watch the ETF flows. They're the new variable clashing with old cycles.